Welcome. You're watching Money, Money, Money. I'm Samara Abdi. If you're anything like the majority of retail investors, chances are that the bulk of your savings would be lying in a bank. Well, mine did for a long time. That's an honest admission. But I'm changing that now. There are people who want to invest money, but they're too scared to lose it. Well, I understand your fears, but remember that not all investments are risky. Investing in fixed income instruments, for example, provides you a steady income along with investment diversification as well as safety. And that's exactly what Harsh Roongta of apnapaisa.com is here to tell us about. Hi Harsh, let me also welcome our other guests. We have with us today Mr. Vikas Naik Navre and also Nikunj Vyas, who want to learn a little bit more about these safe investments. But before I get to your questions, I want to ask Harsh what exactly these fixed income instruments are, or money market schemes as they're called, and what class of investors would they suit?
The moment you speak of safe investments, people think of bank fixed deposits. Now, bank fixed deposits are excellent. It's an excellent instrument. But I think what most people don't realize is there are a number of other safe investments. If you're a high taxpayer, especially, one of the big issues with bank fixed deposits is it takes a chunk out. If you're a high taxpayer, 30% or 31% of your interest is taken out as tax. People think that it is just the TDS that has been deducted as the tax. That is not true. The balance you have to pay on your own. So for those kind of people, these other instruments, I mean, you can talk of tax-free bonds, you can talk of normal corporate bonds that are issued. There are preference shares that are being issued by good companies. Now these are fixed income instruments that you might have. You can also invest in a mutual fund that in turn invests in safe instruments. So I mean, you have what are called the liquid or the ultra short term funds that effectively take money from you and invest it with the banks or bank-like instruments. So they would put it in certificates of deposits of the banks, they would put it in government bonds with very short-term maturity, etc. So they're equally safe. They are investing it in safe instruments and therefore the chance that your money will be lost is close to negligible. Similarly, instead of investing in bonds yourself, which is not very tax efficient, you can invest through the mutual funds. They can invest in government securities, they can invest in corporate bonds, and when you invest through mutual funds, the tax efficiency is higher, which means that you pay less tax. In almost, if you hold it for a year or more, almost your entire return will be tax exempt.
Person investing in property, say real estate, fixed deposit and mutual fund, if you have to rate them from safe to safer, which is the best investment over a period of time and with returns?
So I think two things. Mutual fund is a manner of investment, it's a vehicle of investment. So because you put it in the class of safe, we will talk of say a liquid fund or a income fund or a government fund, okay, a government bond fund, gilt fund as they are called. Those are the class of mutual funds that can be compared with a bank FD. Having said that, I think the three things that are important for any investment, okay, is safety, liquidity and return. In terms of safety, a good bank's FD obviously I think scores the highest on the safety parameters. But a mutual fund which invests in safe instruments, it can invest in slightly less safe instruments as well. That depends on which kind of mutual fund you choose. But if it invests, for example, in government bonds, okay, it's equally safe. Or if it is a liquid fund which invests in certificates of deposits or commercial paper and things like that, again that's equally safe as a bank FD. Property, obviously, in terms of safety, also you cannot compare it with either bank FDs or mutual funds of this category, okay. In liquidity, clearly property does not even come into the reckoning. I mean, it's a very heavy cost that is incurred. So I think maybe in terms of long-term safety it might not be very bad, okay, but clearly liquidity wise it just does not fall in that same category. In fact, the mutual fund, the gilt funds or the liquid fund, for example, scores extremely high. You don't lose anything at all. Typically it has no exit clauses, there are no exit penalties. Whatever interest has accrued you get, then, and you can take as much as you want. You might have invested 1 crore, you want only 10,000 rupees back, you can get that. Now in a bank FD you might have to withdraw the entire amount, or even if you have broken it up, that portion you will have to withdraw. In terms of returns, especially if you are a high taxpayer, clearly the mutual funds outrank the bank FDs as long as you hold it for a year. If you are a high taxpayer, bank FDs make no sense at all.
Also, Harsh, what is the benchmark to which the performance of these instruments can be judged against?
Most of the mutual funds follow the CRISIL benchmarks, and they have different benchmarks depending on the period. So for liquid and ultra short term, they would have a benchmark, I think it's called CRISIL Liquid Fund Index, which is for 90 days. Similarly for ultra short term, it will be for 180 days. They also have composite indexes, which means that they, in a certain percentage, they mix the short term, medium term and long term. Because what benchmark the mutual fund is selecting, that tells you what it is likely to invest in.
Then if you are going to do SAP, let's say systematic investment plan, then what should be the proportion of debt to equity in a selected mutual fund?
Why do you do a systematic investment plan? Because equities fluctuate and you don't really want to take the risk of fluctuation. Therefore you invest periodically. When you invest in debt, you can invest lump sums. In fact, one of the good ways to invest in equities, if you have a lump sum, is to put it in a debt mutual fund, right? And then systematically transfer it to equity. So that takes care of the fact that your money is earning something, but you are not carrying equity risk of one single time. If you need the money in, say, just 2-3 years, then maybe little bit of risk you can take, maybe 80-85% in debt. If you a much longer period, 5 years or 6 years or 7 years, then you can reverse that. You can have 65-70% in equity, maybe 30-35% in debt, systematic.
On that note, it's time for us to take a very quick break, but we'll come back in a bit, and on the other side we'll tell you how your asset allocation into debt should actually change as you grow older. Stay with us, we'll be back in a bit.